Well, good afternoon. Today is Thursday, the 13th of February. I hope you were doing well. We're going to talk about what has happened in the market the last couple of days with regard to interest rates. And y'all, it has been a roller coaster based on a little bit of conflicting read on inflation. So consumer price index came out on Wednesday. It was hotter than expected, y'all. Reset a lot of expectations about when the Fed might move. We were expecting CPI to come in at 2.9% year over year. It came in at 3%. That was higher than expected. We were expecting core CPI to come in at 3.1. It came in at 3.3. So when you look at the core number, pulling food and energy out, especially when we're seeing some volatility in the food market, specifically around bird flu and egg prices. We've seen a bit of a pop in gas prices as well. When you pull that out and you still have a pretty significant 0.2 miss to the upside, markets were reeling from that yesterday. You saw the Dow selling off. You saw the mortgage markets just pricing through the floor. So we saw a big one-day sell-off in bond prices, and of course yields move inverse to the price. So we saw interest rates pop significantly, y'all. A week ago we were at 7 flat in the Mortgage News Daily tracking for a 30-year fixed conforming. 7.00 7 days ago. Yesterday we were at 7.13 based on that hotter than expected CPI read. Today though, we've recouped almost all of that increase, y'all. We're back down to 7.04 in the Mortgage News Daily average survey. That is owing to this morning's producer price index. This is a more wholesale pricing based metric. Came in at 3.6% in the year over year core number. We were expecting 3.7%. So what this did effectively, y'all, is wipe out the pain from yesterday's CPI. And we saw the market recover nicely with regard to interest rates. Just to round out the quote of where we've been over the last 30 days, we were at 7.26% 1 month ago today, y'all. So we've seen nice improvement in rates. We're down about 1/4 of a point from this time 30 days ago. The last 7 or 8 days has been ugly until this morning, based on that weaker than expected PPI number. So thankful to see that. What does this mean for us going forward, y'all? When you look at the CME FedWatch tool, the Fed is not, when you look at the Fed futures trading that drives this number, we are not expecting to see any movement from the Fed now until September. Y'all, this is very data driven, as we have said on all of these videos. It's very data driven. So if we get a much weaker than expected jobs number, if we see the BLS numbers for February when they come out the first Friday in March, pegging a higher than expected unemployment rate or more jobless claims than expected going into that report, that could move this number. Frankly, the inflationary front, it is what it is. If we see some unexpected improvement like we did with PPI, then we'll get a little bit of a pop. But as far as a big movement, y'all, I think it would have to be weakness in the labor market before we saw something really significant to change where the Fed's likely to be. What does that mean rate-wise? It means we're going to be mid-6s, higher 6s, probably for the remainder of this year until we get into the fall. And when we get into the fall and winter months of this year, that's when we may see that pop into the mid to lower 6s if we stay on the current trajectory, y'all. In any event, I'm going to continue to update this as information becomes available. Sometimes the news is so big that we dive in with a midweek update. Happy to do those as well. Blessed to have y'all with us at our new company. RWM Mortgage has been phenomenal, y'all. The pricing is so aggressive. We were always competitive, y'all, with our prior homes, but the pricing here has just been a huge, huge win to the upside for my clients. So in any event, if you have any questions, would like for me to run scenarios, feel free to reach out. All my contact information is on the screen. Stay blessed, stay safe, and we will talk to you next week.